All right, all right. What's going on, everybody? We're halfway through the week. Getting there, huh? Not all that bad. The market is doing what it's supposed to do, and that's always a good thing. We have to continue to focus on the job numbers because at the moment, that is the biggest threat that we have on the table. As we get closer to the end of the week, we have the non farm payrolls, and that's the biggest one. It's not to say that we couldn't see something before then, but 8:30 Friday morning is really the one. There was a good article that was on Mumo this morning, and I thought they made a great argument on the uh, bifurcation between the different banks and how we're in this binary situation of going up or down based on the outcome of what we get at non-farm payrolls. I'll find that article. You guys can check it out. Yeah, this one right here. Momo News, December non-farm payrolls preview. Banks are split. This was a really good read, and it didn't take very long either. They had this nice what do you want to call it? It's not a meme. This image here, the payroll estimates. So unemployment rate, non-farm payrolls, private non-farm, and then hourly earnings average. From there, it's a good read about Deutsche Bank versus UBS, Citi, JP Morgan, Morgan Stanley, and then the fight. Who is on the upside, who's on the downside, and then they get into the trade. What's likely to happen based on what data we get. Now, I was talking to somebody about this earlier today, and they wanted to get into trying to anticipate the numbers. I have absolutely no interest in trying to guess what the numbers are going to be or make some determination that we're going to end up going higher or lower as if we have any clue to what the numbers are. These are big banks with unlimited capital trying to figure out if the market's going to go up or down. And even they don't agree, with some of the biggest names thinking we're going to go up and some of the biggest names thinking we're going to go down. Well, screw that. If they can't figure it out, I'm not going to sit there and try to decide if we're going up or down. Now, on the other side of that coin is the idea that, so what, right? We don't need to know if they're going to go up or down. If we can find some really cheap lotto plays, up, down, hell, do both. At the worst, they both lose, right? Because, the market doesn't have to move at all. And then both of those lottos would lose. But if you've defined your risk and you're willing to accept the consequences, those small trades are a hand slap compared to what they could generate, especially if it's a naked trade, like just a straight call or a straight put without having it wrapped up into some kind of spread. The problem is we have so much right side tail risk that if you're looking at calls, they're very expensive. You can't find a cheap call unless you get so far out of the money, it's almost inconceivable that it would get hit at all. And on the put side, it's kind of the same thing at this point, just because of the elevated volatility. So trying to find a lotto ticket on the indexes is pretty much a non starter. But who says we got to use the indexes, right? If we think that the market is going to sell off or the market is going to explode higher, then screw it. We could choose anything in the bundle, right? Um, Spot Gamma likes to use TSM or SMH as their proxy for the market. And SMH options are a lot cheaper than SPY, at least the last I looked. Because it's the rising tide scenario, right? Or if the tide goes out, then all boats fall. If the tide comes in, then all boats rise. We don't have to pick the SPY. we could choose something like SMH, look at January 9 options, or if you want to give yourself a little bit of room and probably find a little more liquidity, you could look at January 16 options, which is the monthly OPEX. These are running for less than $3 each at the money calls, right? And $3.50 for at the money puts. If you look at SPY, well, SPY's options, at least the put side, is definitely cheaper, but you can see that right side tail risk here. Oh, yeah. Calls are not supposed to be more expensive than puts, right? That's the right side tail risk there. So there is more threat to the market moving up than there is to the market moving down. How do you like that? You got to chew on those shenanigans. Come on, you like it. Yeah, I know that guy. What's up with you? We are talking about a binary event and right side tail risk. Or what they had for dinner. What's your Roomba doing? If we get a binary event move, then looking at a proxy play for Friday, some kind of lotto trade, it's not a bad way to go. But instead of using SPY, I was arguing that we should use SMH until I looked at the cost of the puts. If you want to go down, use SPY. If you want to go up, maybe use SMH, maybe. Because even if it's a little cheaper, the liquidity is still going to be better on SPY. It's not cheaper though. It's let's call it 280, 275. Yeah, 275 on SPY for the calls, or on SMH for the calls, and on SPY they are running. Yeah, they're cheaper on SPY. So all the way around, it's just cheaper on SPY. That is really weird, but I mean it's not out of line. Back the last time we were in this predicament, SMH was the cheaper trade, but now SMH has got so much volatility put into it that SPY's the cheaper trade. But if you guys don't understand what I mean by right side tail risk, back in the 80s when they had that black swan event and people were jumping off of buildings and killing themselves, the options market was equal. So whatever the option price was on the call side, if you matched that same option on the put side out of the money, equidistant, they would be the same price, right? So if 690 is two strikes out of the money and say 694 is also two strikes out of the money back in the 80s, those would have been exactly the same price because there was no skew built in back then. Well, after that big event, they realized that, options are not balanced fairly. If there's a lot of traders hitting on one side, then you've got more supply demand imbalance, and the options prices should reflect that. Well, that generally leads us to where the fear is, fear or greed. Most of the time, it's fear. So people fear a market going down, they buy more puts. Generally speaking, that's what people do. So if puts are bought more often than calls, then put prices are often more expensive than calls. And that's the general way of doing business. unless you're looking at the VIX or oil or something like that, because people don't fear the cost of oil going down, they fear the cost of oil going up, right? So in those scenarios, it would be opposite. But if you look at the situation right now, and I just like to go at the money. I'm going to pick something here just so that the color moves on Thinkorswim here, gets that color down here. If we look at the options that are at the money, which is the way I like to do it, we would be looking at 692 and 691. They're each one just barely out of the money. And the calls are certainly more expensive than the puts, right? So that's what we call right side tail risk. On your options screen, the calls are on the left. So if you're wondering, why do they call it the right side tail risk? Well, if you think about the risk profile, it always has the higher numbers on the right side. And we always talk about markets, moving up and to the right. So, take it over to the Analyze tab, and we don't even need an option in here. We're on the Analyze tab, and we can see that prices rise as we go to the right. So, calls, as we go farther and farther out of the money, that's the right side tail risk that we're talking about. So, in the situation that we're in right now, we can look at the options and start asking questions like, well, what is the market pricing in? Not what analysts are saying. And, you know, that's just them running their mouth. Where are they putting their money? They're putting their money in calls. We can see that because calls are more expensive than puts right now. There's a right side tail risk. We'd like to think that they're buying those calls, but we can't necessarily make that assumption. We just know at the moment that there's a lot of calls being traded. And of course, every trade has both parties. If they were bought, well, somebody sold them. And well, if they were sold, well, somebody bought them. There's always going to be an opposite party. So we don't have to really get too hung up on, well, all of these calls, were they sold or were they bought? They are. And there's enough of them that they have skewed things on the right side, and that is our risk. There's models and formulas that can display the standard deviation bell curve and show you that right side risk. Say this area would be that 68%. And then the next standard deviation may be way down here on the call side, and yet just right there on the put side, where this distance is a lot closer together than this distance because that right side is skewing out so far, right? So, right side tail risk. We can take this information and then we can start digging into it. Look at the open interest, look at the strikes that are being traded, see if they're pooling in a particular area. We can look at any sort of spreads that were put on through the time and sales to see, are they running any sort of collar trade or some kind of risk ratio trade? That would be something where, say, they sell some puts and then they buy the calls because, the calls are so expensive right now, or that they sell the calls and they actually buy some puts because, well, the calls are so expensive. If you're going to sell something, you might as well sell the one that has some juice to it. But we don't have to assume that we know the answer to this. We can just go in and look at what the time and sales are showing us. Set your filter to something like the 10, I think Thinkorswim will offer us, if it'll quit freezing up there. Come on, baby, you can do it. I got faith in you. Now, I like to turn off this or turn on this conditions one so it hides a lot of those like pre-built verticals. You'll still find a condition now and then, but mostly the color is going to tell you if it was sold or bought. bought being green on your platform, blue on mine, or red if they're being sold. And then, of course, see all these ones? That just muddies the water. So go back to the filter and turn on at least a two, right? And that'll help filter out those one lot warriors out there. Nothing wrong with even bumping it up to enough where it stops moving every second and maybe only moves every 30 seconds or so. Probably a 50 lot or a little bit bigger would get it done. That way we can analyze what's happening in there without trying to chase it. We got the top 10 trades up here, and we can see when those trades were put on. Now these are set to my local time frame. So if it says, that a trade was entered at 9:15 or so, then market's not open at 9:15, but in my time zone the market opens at 8:30. And so the numbers, just be mindful of that if you're looking at my screen wondering why the numbers might look like trades were done pre-market. So at this point, we can see a lot of puts and a lot of calls, and they are spread out into different expirations. The puts are really right up front, January and February. But if we look at the calls, we've got June in there quite a bit, and that's not helpful. That's not helpful at all. It's not pointing us to any sort of resolution or solution. Once you see where they're hitting, you can then come back up into the options chain and try to see if those were new trades or not. If the open interest is less than the volume that was coming in today, then we know that those are new trades. That doesn't necessarily help us if, the open interest is 48,000 and we see 30,000 trades come in today. Are those 30,000 new trades? So, tomorrow we'll have 78,000 open interest, or is this 30,000 volume from today those traders closing down some of this open interest? We can't tell from here. We would have to go back down into the time and sales and try to see if we can spot that. Of course, you can also just chart this thing, right? You can put it on a regular candle chart and look at the volume and then see, well, what was the volume doing? Is it red? Is it green? You know what I mean? That can help point you in the right direction too. So here we are looking at that one call that we were focused on with 43,000 open interest and 30,000 volume traded today. And we can see a lot of buying at the open, around 2,000 contracts. And then it's been a lot of selling throughout the day today. Does it equate to the 30,000 if we were to add all this selling up? Maybe, right? It looks like it does not to me personally. It doesn't seem like we've got there. But that would help try to answer that question on what are they doing with those calls? Are they selling them? Are they buying them? And we still don't know, are these calls connected to some other trade? What if they're running a calendar of some kind, right? Like say they're long back here and they're selling calls in the front end. We don't know, right? We just got to look at the data that we have. So the calls are certainly getting more attention than the puts. We do have skew. We've got a lot of volume coming in for this Friday, which is fair. And the options data is pretty muddy. And that's to be expected because we just saw the article about the banks where some were long and some were short. And we're talking big names in those banks. Like I said, if they don't know what non-farm payrolls is going to do, how the hell are we supposed to know? And we're seeing those big traders show up in the options, but the options aren't giving us any better answer because both sides are trading really big. So not helpful, right? Not helpful at all. Should be able to set the skew on this. I think we need to go to average and then There we are. So this is what they call the smirk, right? Or at least the smirk is what we're looking for. If you think about a smile, right? The smile, good enough. Then you'll have the smile that goes all the way. But if it's a smirk, then it doesn't quite get there, right? And of course, that smirk can be the other way too. Doesn't have to be, this way. It can be this way. And that's what we're seeing here, that we don't have it coming all the way back up again. Now, this is for the 9th. We can add today to that just to get, well, it's already too late. We can add tomorrow to it just to get a little bit of perspective. And then the OPEX day. I think the OPEX day has a lot more to offer. Now, if you're thinking, why the hell do I care and how can I use it? Well, think about you out of the money options traders and how you're trying to find exactly how far out of the money you can go before your options trade isn't benefiting from it anymore on the sell side. Say we wanted to sell some calls, a call vertical. If you run just some default survival answer of 10 delta out of the money options, you may end up on the wrong side of that curve. That's why a default delta answer isn't such a good idea. Here, I'm out of the money just a little bit. I'm running 96 and 97. It's a short call vertical. And we can see $1 wide, 42 cents. What if I go out one more and I use a 97.98? Now it's 39 cents. Do it again. One more out of the money. Now we're at 34. Now we're at 31 or 30. 28. So you can see it's stair stepping lower, right? But at what point do we get so far out of the money that it's not helpful at all and it actually starts going in the wrong direction? It starts climbing back up. This one looks a lot like the last one. So let's go back to this. This is 701, 702, 23 cents in credit. 702 to 703, 20 cents in credit. Okay, so it looked like it was. Maybe I misclicked or it started to move again. But what we're looking for is that curve. I probably don't have enough strikes showing. What would happen if I had enough strikes showing is we would start to climb that curve, right? We'd start to climb back up, and those options that we're trying to sell, they would start going in the other direction again. We'd actually start to find more credit, even that far out of the money. And now I've shown this in Apple. I had a blog post written up once where I found a spectacular options trade on Apple. And if you went a little closer to the money, you got less credit. But if you went a little farther out of the money, you got more credit. And believe me, that's not how things are supposed to work, right? But it was because of that skew. So if you know that there is right side tail risk and that you've got uh, enough curve here that you're not just getting a smirk, but you're actually getting a smile, then you can try to hunt for that turning point in the options, especially if the turning point is out of the money, right? A lot of times that turning point is at the money or even on the money, in the money slightly. Let's zoom in here a little bit and see if we can spot the turning point for this one is about, I missed that one. Looks like it's about right there, right? For this one. And yet the red one, its turning point is around this point right here. Well, if you look at the price of SPY at 692, 692 would be somewhere in here. So we're looking for that turning point. The shorter duration one, which is the purple one, it's going to turn right around 698, 699, right around in there. But if you're using next week's expiration, it's going to turn around 708. That's how much farther we would have to travel before we start to see that turning point. Go away. There we go. So if you're trying to find a cheap out of the money call to buy, for an example, you could also use this logic. Don't go so far out of the money that you start climbing the curve, because then the calls are going to start to get more expensive again. You might not be able to spot that necessarily, because they would still be, cheaper, but it's still going to be there. So let's see if we could find that. We're going to just turn them all on, and we're going to use, let's start with the Jan 9, see if we could find it way out there. So we got to scroll, scroll, scroll. So they got a lot of strikes. And then, of course, you got all these bag holders where the prices are just, they're the same, same, no change. Here's where things start to change right in here. So 8776 65 54 54 right there. This is where we start to double. 716 715. Anything outside of that. Now I can see it because it's in the prices here, right? But if you're not used to reading this stuff, then you have to learn to start to look for it. This is where everything stops. There's no benefit in going any farther out of the money than that. And since this is really close to the edge, I wouldn't trade either one of those either. I would just skip those, because you want ones that, couldn't slide into that default zone on their own. Maybe, something closer to the 710, 711, 712 area. That way you're not handicapping yourself. Now, how far out are we? I don't have Delta on, so can't say, but we can just use the prices to guide us to make sure we're not too far out. What's the realistic likelihood that we could hit one of these numbers way out here? Call it 712. We have a $10 expected move, and we're at 92, 692. So a $10 move would put us at 702, and we're looking at 712. That's 100% more than the current expected move. Is it possible for us to hit that? Yes, absolutely, 100%. What they teach when it comes to this number is that this is just your base number, right? It's your baseline if everything behaves and nothing gets out of control. If things start to get out of control, multiply that number by 3. So your wild and woolly number is actually a $30 expected move, higher or lower. And so as you can see, we can easily hit 712 if things were to get out of control, right? But this is 100% a scratch lottery ticket. This doesn't have any sort of technical analysis behind it. We're not reading trend and momentum in the candles and identifying, possible patterns and signals. And we're just throwing it out there looking for a binary event to move the market. You wouldn't want to develop an entire portfolio of trades like this, right? You're just trying to take advantage of the situation. And if you can find the skew giving you edge somewhere, right? If one team was dominant, let's go back to that news article. If the bullish outlier group was more dominant and we could see that in the options, then great, right? Then we could go that route, but neither side is is in control. We had a topic request today that we're going to get to as well. And this is about reciprocation. It's what I call it, anyways. Oftentimes, this equates to measured move, really. But if you think about linear regression, and we're just going to go out to a daily chart for a moment, we're going to get rid of this option and just put SPY in there. It really doesn't matter what we put in. Think of your basic general linear regression line. Start at the lowest point of your chart. I mean, the way this thing works, that's the lowest date. So I'm going to start there. Notice my mouse wasn't there, right? I was way up here. But left to right, I started at the lowest date, drag it across. Now, what it's trying to do is normalize the midpoint. If we did this a little differently and I started when we were already in a channel and we just ran it through that channel, you can see how price is holding steadily above and below. This is a perfect example of reciprocation. What you got on the bottom, you got on the top. RSI does this. MACD does this. It's funny too. There's a lot of RSI traders who say it owes them. If you get a 7 RSI on one side, then it owes you a 93 on the other side. How you like that, right? Like it's reciprocation. 50 being the midpoint and closer to zero or closer and closer to 100 is your reciprocation levels. So this concept of reciprocation is dominant throughout the trading marketplace. It's in all kinds of theories and styles and approaches to technical analysis. It's not just me. It's been around for a long time. I just use the fancy word reciprocation. They call it some other thing. But most people will understand jigsaws, right? You pick it up, it's got the saw blade popping out of the top of it. It looks a bit like a gun with a blade, a jigsaw. And what's that jigsaw do? It moves a specific distance forward and backwards over and over and over and over and over again. It's a reciprocating saw, also called a jigsaw. Once we've got the identified distance, we can try to match that distance on the other side, or at the bare minimum, we can project that distance to the other side on the expectation that that's what it owes us when we eventually cross over. I probably should have used a brighter color. It's not just RSI, it's reciprocation in general. If I get 2 points above, it owes me 2 points below. Reciprocation. If it goes 9 points above, it owes me 9 points below. Reciprocation. So in RSI, for an example, if it printed a 10 on the bottom, it owes me a 90 on the top. Why? Because 10 is 10 points away from zero, and 90 is 10 points away from 100. Bollinger Bands too. If you get within 1% of the upper Bollinger Band, it owes you 1% away from the bottom of the Bollinger Band. Reciprocation. That's exactly right. This is not a new concept, and I certainly didn't invent it. It's been around for a long time. They just don't use that word, right? They use other words and other phrases, and they muddy the water trying to find fancy ways to explain it. But at the end of the day, it's just equality. Whatever you had on one side is what you're going to get on the other side. You can always add the little asterisk and the caveat that says, Results are not final, results are not guaranteed. The market can do whatever it wants and blah, blah, blah. But we can go back and we can look and find these examples again and again and again in the market. Sure, you'll find ones that failed too, but no pattern works successfully all the time. And all we're looking for is an area of warning or risk. I marked this one first, and then I carried it over here and I set it down. I had to change its color, so then I copied it and moved it back over, but that was the measure, and it went that distance. I didn't cherry pick it, I just went to the next one, the next time we crossed over. Reciprocation. So anytime that we have price behaving in a normal way, we can try to find the mean or the midpoint for that price, whether we're looking at price in a range, price in a channel, whatever it happens to be. If we can find the mid, we should be able to identify the swing point. And then, of course, you have the high or you have the low. You have one side first. That's what you begin to measure. And then you look for the breakover and you set that measurement down wherever the breakover happens to be. If you're looking for examples, you could certainly aim for the highest high and the highest low. If you're looking at, what's coming up, then you're going to look at whatever it gives you instead. So take today for an example. We have a market in trend, right? Lower highs and lower lows. And if I was to snap a Lin reg on this from the highest point of the day, now we've got a channel established. This is what we're working with. And I could measure this distance and see if it matched that distance just as a check, right? It's like looking at the gauges on the car, making sure that everything is functioning well. If I measure this one and it matches this one, then we're good. We can then measure this one and see if it matches that one. If we are, we're good. We can now plot one here and expect price to run it, because this one matched that one matched that one, and it's telling us, yep, things are behaving normally. Try to run reciprocation. If we didn't have those yet, say we only had this, we've got the low. Well, I get that's what we got. So let's work with that. We would measure this distance, and then we would plot that distance up here and look to see on the breakover, did we get that measurement? Just start with one side, right? Because one side is all you should have if you're just starting the day and price hasn't done anything yet. Now, in the briefing, I had VWAP on. It doesn't have to be VWAP. It could be a moving average, but generally I tend to use VWAP quite a bit for this scenario because VWAP is going to be the mean, the average. So at midnight, mine resets and we can see how price was moving above and below VWAP. Reciprocation. Now, if it's really ugly and sloppy like that was, then there's no real great value in it, right? We want to run with the patterns that work. If you bring it up and it's sloppy and it's nasty and there's no value, then screw it. There's just no value there. But if you bring it up and you got a really good, clean signal and a really great pattern, now you got something to work with. So, don't expect to find it everywhere every day. The idea is if you spot it, use it. Here, for an example, we had a really clear change to the downside. This big move was an outlier and it was very clear. And that was a big distance away from VWAP. Well, now it owes us the same thing on the other side. So if we get rid of my drawings, and we just use a measurement. We got to measure from where it broke out, which was, it actually came back in and tested here. So we're going to use that. Darn it. My extension is back on again. Let's turn that off. Change the color so we can all see the darn thing. I like the lines to stay hidden when it's just me. And I mean, they're not hidden, but pink settles into my colors really well. And if I don't want to see it, I can just look past it. But that doesn't help in the video. All right, so bright, clean line. We can all see it. It's big and fat. Save it as a default. So it owes us this on the other side. When we finally broke, I could have put it right here, but we only broke for a moment and then we came back in. So now I can move it. The next time we broke was right there. I can put it there, but let's zoom in. That one failed too, and we came back in, and then we finally broke out here. That's where I would attach it. Look at that. Is it perfect? Nope, but it's damn close. It's what we hit when we stalled out. I didn't cherry pick that, right? All I went and did is zoomed out and found a really clean example of how far we had moved from VWAP and measured it. That's all I did. Now, does that equal a trade? No, not necessarily. If I was long in that run, I could have been cautious of a reversal against that level. Start taking profit before we get there, be ready for it to slam shut on me, right? All of that. Or if I had been long and I already got out before we got there, I could be looking for a potential reversal there, right? It doesn't mean that it's going to give us a trade per se, but at the very least, it can warn us of a potential risk area. That's 690 and a half. It's already a potential risk area, but if it wasn't, then that's pretty awesome, right? Reciprocation. And this concept is also used in trend logic, right? If you think about what price does, you get the move up and then the pullback and the move up and then the pullback and the move up. You can measure that distance from A to B, and you can measure this distance from B to C. So that when price starts to run again, you take that measurement and you set it up there, and that tells you where we should pause at the next run. And then you measure this B to C and you set it there, and it tells you how far we should pull back on that next one. That is straight out of the trend textbooks, measuring the impulse or the leg and then measuring the pullback so that you can gauge trader participation and whether they are still, you know, uh, cycling back in as others take profit, or if they're slowing down in their aggression. Are they getting more aggressive? We can look at what price did versus its measurement to see, is the trend speeding up, is it slowing down, all based on that same measurement. Same logic. So here we got the ES. We'll just put more days on it since we've looked at all of these days already. And we don't want to cherry pick. Thinkorswim has to kind of do its thing. Where'd my VWAP go? Oh, shoot. I did get rid of everything. That's my bad. Put it back on. All right. Now my VWAP resets every day at midnight. Yours might not, and that's okay. It doesn't matter in the grand scheme of things, because the regular VWAP will reset at 6 p.m. and mine resets at midnight, but they both reset. So every day you get, quote, a new VWAP, and it should owe you that sort of reciprocation if you spot that we left the range and have gone somewhere. Like, see it here, it's just getting completely out of control. And I think that's because of the contract change right there, right? It's probably hard to see, but that's a contract change. So we'll stay on the right side of that contract change. And we want to find a reciprocation example just to kind of highlight how it goes over and over and over again. Maybe even some examples of what we don't want. So, here, for an example, this is what we would not want. It's really tight, it's all just squished together, it's not doing anything. So, you could measure it, but this would be really risky to measure. Don't expect that it's going to work in all scenarios and all situations. And with this really tight, compressed price, that little bit of a push there, I don't know that it would be worth even doing it. We never got below to find out. Otherwise, we could have at least tried, but it never got below anyways. It was just holding up. So don't force the issue. This was a really good expansion, but then we ran out by the end of the day and we never got a chance to get below. Well, you need to have a swing. So, yeah, this not too early, right? If you come in and it's already moved above and it's already moved below and then it's moved above again, then you've already got an established move. For me, I'd rather catch the first one, right? Like in the morning briefings, a lot of times we're seeing the very first one of the day right around that 7:30, 7:45 live stream. It's usually one at that point, and that's perfect because it's the first one, right? And that way we're not looking at four, five, six swings on the day. Here's another one where let's start with the midnight push to the upside. There's the midnight crossover. A little above, a little below. It looks like it didn't work out equally either. We went a little deeper than how high we were, but big push here and big push there. If we measured them, would they be the same? Close. I can see that right now. It's pretty close. So there was the first violation of distance. So that's where I'm going to put it because these others, they didn't work. That was the one that really ran. And I'll zoom in just so we can see that better. That's where I put it. And that's what we hit and stopped. We got underneath it, but we came back up to close above it. And then the next one, we got back below it and we came up back up above it. So that, hey, Marziti, I always appreciate you stopping in, buddy. Don't work yourself too hard. Yeah, you could use it in any number of ways, and it works on all time frames because price is fractal. So you could do that on a 10-second chart, a 30-second chart. And anybody who's already been familiar with the way that Jeremy does things and his Linreg lines and his all the different spectral lines that he uses, this concept is right up that alley, 100%. For me, a lot of times I use it more for analysis, planning, and anticipation, not specifically for a trade, but you certainly could. Nothing wrong with it. For me, if I've got that line and it says that that's where price is supposed to turn and it turns there just like it's supposed to, then I know price is behaving today. So that's one of my main questions every day. Is price behaving and acting rationally, or is it just going completely off the rails? Because honestly, we never know what we're going to get on a day-to-day basis. Maybe we're running on wild speculation because of news, Trump tweets, or whatever, just spiking the market and driving us crazy. If it's like that, then I know technical analysis is going right the hell out the window and we're going to need to use something else. But if price is behaving the way it's supposed to, I trust my trades a lot more. I'm willing to size up, right? I'm willing to take another bite of the apple. I treat the entire day different when price is doing what it's supposed to do. But if it's acting irrational and it's not following the turning points the way it's supposed to, I'm a lot less interested in participating, and I'm going to reduce my position size considerably, taking profits sooner. I will pass trades that just, I get a lot more defensive in my behavior and in my attitude because price is misbehaving. That is a really nice head and shoulders right there. If it wasn't for this, it would be perfect. But I have found over the years that I don't want a bump in front of the bump. I don't know why. It just doesn't pan out as good. Doesn't mean that this probably won't pan out, but also when it comes to head and shoulders, I've noticed that this shoulder should be considerably higher than this shoulder. And it is higher this time, but not as high as I would have liked. Because when I go to draw the line, I want the line to be at a good angle like this. And this one is just barely angled. It's not very much of an angle at all because we want that neckline break. Would it work? I mean, probably, but garbage in, garbage out. You get what you give. If it's a sloppy setup, probably going to get a sloppy outcome. It may not be worth it. Still, we could snap it anyways. Oops, wrong line. Please. The measured moves that I picked up came from just the regular textbooks that are out there about candle patterns. I can't say that it was one particular book because every single candle book that I've ever read about talks about how to measure trend. Every one. I don't know that I've ever read a candle book that didn't talk about measuring trend. Well, I took the concept of what I got from the candle book and applied it to what I saw happening, for an example, on VWAP or what I saw happening when we snapped a Linreg line. So once you see it, and it's the same measurement we do measured moves on falling wedges, rising wedges, head and shoulders, neckline breakouts, right? It's the same thing for trend, for all those patterns, the same thing. So when I seen it on VWAP and I seen it on regression lines, I thought, well, I would just apply it the same way. Why, you know what I mean? Like, why wouldn't I? If that's the same way that I've measured every single thing else before that, I would do the same thing to those. And that's what I did. And it works out just fine. I didn't have any reason to think that I shouldn't do that. It's like, I don't know, like, you come up to a glass elevator and you've never seen a glass elevator before, but you've certainly seen elevators, elevators and elevators and elevator. So you do what you've done at all the other elevators and you just push the button and sure enough, it does what it's supposed to do. When I seen price moving above and below VWAP, the first thing that I thought of was, is it measuring the move? And I measured it and sure enough, yep, it worked. Yeah. You gotta get to the point where you're willing to experiment just to see what happens, right? Not with your money. That's crazy because we got to defend the capital at all costs. But to be curious with technical analysis, to just ask the question, I wonder if, and you just try something and see what you get out of it. Those curious questions have led to some of the most fantastic systems that I run today. Just me being curious and asking questions like, I wonder if I do this, do I get a consistent outcome? And if I don't, then it's like, all right, well, I guess that didn't work. I'm gonna try something else. Yep, that's the best way to do it. So you can experiment on different things. Um, I like VWAP more than moving averages, but I have seen it work on moving averages. Mostly, if you're going to do it on a moving average, it has to be on one that we haven't had contact with for a while, right? So, don't go out to like a daily chart where we've been just slapping across the moving averages back and forth like crazy and then try to measure it. I found that that hasn't worked at all. But if we've been in an established trend, for an example, and we've been riding above a moving average for a considerable period of time, and then we cut through the average, the cross back is often going to be a measured move as well. So a reciprocated move. That's a good way to play. But it's too particular, right? Like there's too many caveats. Don't do this. It needs to look like that. And that's just a bad way to do business. So I'm not a big fan of bringing moving averages into the discussion, but VWAP's fantastic because it resets itself every day and you get like a do-over with price and they have to both start at the same period of time. It's perfect. I don't know a better way to say it, but VWAP is an excellent way to run this system. Linreg lines are okay, but where do you start? And that's always an issue. Where do you start the Linreg drawing? I've got some scalp programs that I run where I zoom into a particular zone and then I run a Linreg line and I continue to run that line out. So say this was my zone and I'll keep drawing that line as long as price keeps moving until finally we break the channel and we start to go the other direction. That works out until it doesn't, but it's complicated. It's a small time frame thing. It's my scalp program. I haven't found that to be viable. You can use it on swing trades. It certainly works better out there, but then you're still stuck with where do I start the Linreg? If we're in a range like this, you're better off not using the Linreg. You're better off just using the range itself, marking it from high to low and running the box and not worrying about it. But then, there's no reciprocation here because you're just looking at a box. You got to get a breakout. So if you've got an established channel and you can snap through the channel, you're pretty good. But that's completely different than the VWAP, where in the morning we have maybe our first high or our first low, and we're measuring that, and then we're projecting forward where the next one will be. This way, it's already an established channel. The highs and lows should already be established with its edges. So, like Marziti said, at that point, you could bring in like Bollinger Bands or Keltners or whatever, because you'll have your edges. Um, I believe Think or Swim does. I'm gonna turn on a regular VWAP. The one that I've been showing is custom. So this is VWAP on the daily using Thinkorswim. So yeah, it is there. Back in the day, I was setting up a system for this, and then I moved on to a different thing. What I had been setting up was whether or not we were above or below VWAP as the day began, and at any point during the day, did we change across, from above or below VWAP? I I think the reason that I gave up on that system is look at the price, 6990.14. Well, of course, this won't work on SPY, but if I come in here, 6990.14, it's the same thing. That VWAP answer here was the same on my 5 minute as it was on the daily. Funny enough, it's the same as it is on the 15 minute, 45 minute, daily, weekly. It won't matter. The answer is still the same, 6990.14. The VWAP didn't change. So I ended up just scrapping that program. But I was curious, asking one of those what if questions. Yeah, I have shared it many places, but it's easier if I just give it to you rather than sending you to the toolbox because I have so many versions. I wouldn't know which one in the toolbox is this one. Now the midnight reset actually comes from Jim Dalton and Peter Resnicek. For people who don't know the name drop, Dalton is really big into TPO and footprint charts, and Peter Resnicek was a protege of his back in the day, and he used to run the Shadow Trader chat room here on Thinkorswim, the Trader Lounge. Peter Resnicek helped Tom Sosnoff and Kaufman and Rosenblum and all those guys build Thinkorswim out before they sold it to TD Ameritrade for a couple $1 billion. So these guys, they didn't get to program the indicators. That was Spearman, I think is his name. This jerk professor. He was the one that was doing the indicators, and he set the reset at 6 p.m. Now, Peter Resnicek and Dalton, they didn't like the 6 p.m. reset. They argued that the midnight reset was the better way to go, especially if you're using futures. So I heard them talk about it, and he made a good argument. I started using the midnight one, and I found it to be really good. But honestly, if you put them both on by the middle of the day, they're almost always overlapping each other, anyways. So it seems you got to remember, I do most of my futures trading in the morning before 7:30, right? And that's where I find the most discrepancy between these two indicators, and I like the midnight one better. If you're going to use it all day long, I bet it really doesn't matter which one you use, right? Look at today for an example. We'll just zoom in. They're overlapping each other by 10 o'clock, and there's no daylight between them. It wouldn't matter which one you used, but look at them in the pre-market. Yeah, now there's a difference between which one you use. And look at how mine has reaction around price. Theirs, price wasn't even there yet. Yeah, he is good. He's a smart guy. He trades really big, and I disagree with some of the risk that he takes sometimes, but he knows his business for sure. If anybody's listening and they're thinking, you might want to go follow him, don't do it unless you got a big account because he calls out really big SPX trades. And it's an expensive service. If you don't have the account size to follow, then you're just paying this expensive service and then you can't trade his trades. Yeah. Hey, but his community is awesome. Great people in there that he's had for years. And every once in a while, he'll get one wrong and blow up half the people that are there and they all leave salty. But those are the ones that had been there until the first loss, and they started trading bigger and bigger and bigger, and one bad move, they don't have any risk management, and they blow themselves out of the water. But it's he's a smart guy. Been around for a long time, much longer than me. So that's why I use the midnight one. But you could use either one, especially if you're trading in the regular session. They really do overlap almost perfectly. So right now, one of the big things is the transition in AI from massive money output to starting to monetize and bring things in again. And the hottest subject, I guess, I don't have a better word for it, is DRAM. Even NVIDIA this week with Jensen Wong was talking at the big conference about how NVIDIA is the major procurer of this DRAM that's out there. Pretty much they're buying everybody's DRAM, and there's not much left for anybody else to buy any because they're buying it all. So of course, that's got to leave us to thinking, oh boy, market like that. That's got to leave us to thinking, well, what company out there is developing, marketing, selling VRAM because or DRAM, because that company's probably hotter than hell. Um, the companies that are, you wouldn't want to trade like pink slip little turds, but there's an ETF. I think it's shoot, man. I mean, hopefully I still have it on my screen. Ooh, no, I don't. Shoot. So my notes, maybe this ETF. I'm going to start building out a position in it. It is certainly got to be the focus for this year, that DRAM, right? I'll find it. Give me a second. It's like it's almost like one of those country specific. It is country specific. It's Korea. Whatever Korea is South Korea, which is like XWY, I think. Maybe XYW. Let me just check my notes. There's a double, no, a triple leveraged South Korea too. You'll when you see the chart, it's just you're going to understand exactly because the thing's moving like a rocket ship to the upside. EWY. Gosh darn it. Exactly. EWY. So this is the Korea ETF. This isn't the double leveraged or triple leveraged or whatever. This is just the regular one. Now, Korea, the two companies that are really big for the DRAM that we would want to play, they make up two-thirds of this ETF with just those two names, or not quite a half. It's like 40 something percent of this ETF is made up by those two companies, and they're the ones, right? And that Nvidia is buying everything that they can make hand over fist, sold out of production. So you got SK Hynix, Micron, Samsung, HBM, all sold out, right? Those are major suppliers of DRAM, and they got nothing. Now, SK Hynix holds the leading position in the global DRAM markets. That's early 2026 statistics. It was their top spot for their multiple quarters in 2025. here is a picture of the fund. If I can get it to come up. Come on, don't be that way. Fine. Fine. I will put it in the chat. Which is fine because I'll get to take a picture and make it as small as I want it to be. And I'll bring that out to the live stream so people can see who's watching the replay. This is what we're talking about. That ETF, EWY, has these sectors within it. But the top holdings, which is what we want to focus on, is Samsung Electronics at 26%. And SK Hynix at basically 19%. Put those two together, that's your almost 50%, right? Almost 50% between those two companies. It's napkin math, but you know what I mean. All right, let me bring that one up for the stream. That one's harder to read. I shouldn't have took such a big picture. Maybe I'll take another one. Samsung Electronics and SK Hynix, right? Look at that. Compared to everything else in this fund that has less than 2.5%, those two stand out. That's the play, right now. Maybe we get something else between now and then, but that's it. And one of the things that I had planned on doing, I didn't get done today, is China's not broken, right? China's kicking butt, and they're kicking butt in this space too. I want to know what company in China is their predominant DRAM supplier, and do they have a US ADR that we could trade? You know what I mean? Like Baba, Baidu, JD, PDD, those are all ADRs that we can trade, proxies of the companies. What is a DRAM company that they could have? Yeah. I don't have an answer, by the way. I haven't had a chance to look. But this, yeah, well, KWeb is the internet ETF, and I love KWeb. KWeb is a great proxy for playing China stocks because this is like their, think of our XLK, which is the US ETF for technology. This is China's ETF for their internet stocks, KWeb. So it's not the exact equivalent to our XLK, but kind of. But I would want to hone in on a Chinese company that specifically focuses on DRAM generation, development, production, because that's the AI choke point. They can't get AI out the door fast enough, and they need DRAM. Now, does NVIDIA end up buying one of those companies? I don't know. You know, but JD, Baba, and Baidu, they are not performing in the ADR as well as the Chinese market version of them, right? Like the Chinese ADRs have just underperformed drastically. We were all looking at them in 2025 to be fantastic movers, and it didn't work out at all. In fact, now that we're talking about China, um, I like to use stock charts for this. Helps if I spell correctly. Because they've got the China market. Oh, what is it? SNN. There it is. SSEC. It's one of them. The Shanghai Stock Exchange. The thing's been on a tear, right? Put it on a monthly, jack it out 25 years. Now, this isn't the one. There's another index um, over in China is doing much better than this. And it's nuts, just going like straight up. Haha, which one? Did it mention a China ETF specifically? A semiconductor focused China ETF? I'm checking my trade notes for the China one that I know I'm gonna find it like duh, of course it's that one. That makes sense. It's not the answer we wanted, but that makes sense. I've got a market I'm looking for. Just gotta crawl through my charts here for a moment to find it. It's not going to be the DRAM. It'll be the China Index ETF. SSEC. That is the right one. That's the right one. I don't know why it doesn't look as. Maybe it's just the chart. Should have had a chart style library already made. All right, there's the weekly. This thing has really been picking up, but China's advancement is doing, really well in this space. They're not hurting at all, and their AI costs are comparable with ours. The tools, their agents, in some ways surpassing ours. So look at that and then bring up something like the full NASDAQ composite, which is COMP, well, COMPQ, depending on what broker you're on. It's almost like we didn't even change the chart. Same outcome, same dip through the April timeframe, same run back up, everything. So they're in the same boat we are. They've got the same DRAM problem that we do. And South Korea is the bottleneck. And that EWY is the proxy. I think this will be a good space to kind of keep an eye on this year. For those, that want to just buy and hold, I guess you could, right? But it's not my style to do that. One thing to be mindful of is this is a Korea ETF, right? So the moves happen after hours. That's why you have such big gaps. By the time the US market comes in and this thing is quote open again, we've moved a considerable distance. So if you've traded something like the emerging market ETF, the EEM, or this, you're just gonna have to get familiar with these gaps. It's scary because it can gap against you and that can really freak you out. But the gaps work both ways, down and up. And this is not one that you want to run for a kind of a gap close program. The S&P, for an example, has a really good track record of closing its gaps. Not a product like this or emerging market dynamics. They just gaps are the norm, not the exception. So, it's less than $150, so it's kind of cheap, all things considered. It doesn't have great options, as we can see, right? They're not very liquid at all. But it hasn't really, I don't think it's really been found yet. I mean, sure, it's getting lit up. Think about back in April, how far we sold off in the S&P and the Nasdaq, and everybody was taking a beat down. Not this. And when we came out of that April low, it's been game on ever since. That was the trigger, and it hasn't stopped. It slowed down a little bit. And then when we started having all that rate talk, right? That's when they unwound a rate cut, and then they priced it back in, and then they unwound it again, and then they priced it back in. And we've been going ever since. Now it's gonna pull back again, which is why I'm not a huge fan of just buying and holding. But if you don't want to miss the run, something like this can go parabolic and not stop, for 20 points like it did back here from 50 to 70 and then it finally took a break. Or it can go from 80 to 100 and then pull back, 15 points. So if you do buy in even when it's extended, sure it could continue to run another 20 points, but it could fall back down to 95 easy too. So start small and average in is what I would recommend if you don't want to wait for a particular entry. I've certainly averaged into runners like this before. And of course, I've had some work and then I've got my butt handed to me a couple times because that's, that's the way it goes. They don't always work. But usually with my, oh, I don't know a good word for it. With my flavor for liquidity, I don't generally trade something that's not liquid. And that way, when it's not working, I can at least defend the trade with some options. Well, this doesn't have much option defense. So you're pretty much just stuck with the shares. It's not to say you can't do any options at all, especially if you're on the sell side, but not a lot of defense there. If it gets found, which right now I don't think it's been found yet, this thing's going to take off like crazy. For an example, ASTS. This is one that, was not on anybody's radar. If you don't know what these guys do, they're a lot like the satellite phones or satellite internet that Starlink does, right? These guys are space mobile and they are competitors to Starlink. And they're small, all things considered. And nobody was watching them. They weren't on anybody's radar. And then suddenly they got found in that same April low this year, well, last year, and just took off like crazy. I need to turn off the log scale so that this chart really highlights what we're talking about. I guess it was April of 2024, not April of 2025. But it took off, got a little excitement, gave back more than 50% of that run, and then went stable for a while, and then away we went. And it's been a wild ride from $20 to $100 last year from that April downturn. That's a heck of a run, right? 4x your money. 4x. But now we're stalled out against that 100. And like I always say, right? If 80 then 100. Well, if 100 then 200. But we got to get it and we ain't been able to get it. Touching it doesn't count. You got to get above it, claim it, keep it, and then you start the next leg and the company grows and it starts getting added to the other indexes, and they get better liquidity. But that's just not it, right? So that's what it looks like when a company gets found. That ETF, I mean, only the people that's really been digging down into this have really started to spot this at the moment. I think it's going to grow. So, of course, I'm looking for mean reversion. If we snap Linreg, now that I've normalized my chart, we can drag it across here. I don't know that I got all the way to the edge. Yeah, I did. Did I start at the right spot? Nope. I overshot that a little bit. There we go. So there's our reciprocation above and below. We are setting a level that's never been set before, which has to make you nervous because that means we're going to set, a lower level here that we haven't set before. But when, right? And that could be, this is a monthly chart. So it could be a year from now before we do that. And we don't have to do that. That's the thing. And it doesn't even have to pan out. But I would look for a pullback on this run. A healthy pullback would be 786 from whenever we finally start to turn. We haven't started to turn yet, but when it does, that would at least be 95 if this is the current turning point. That's a $15 haircut, right? From 110 to 105. But after that pullback, should be good to go. And if you look at the 786, it lines up with this structure back here. So I like that level. That would be a bit like a Busby, breaking out, coming down and checking old resistance for new support, and then making that move to the upside. So DRAM, keep that one on your radar if you see, headlines, news, anything talking about that space, and maybe any sort of M&A deals or new companies IPO, anything like that. Here is the December 31st stats on the different indexes for 2025. I'll bring that up in the browser too so you guys see what I'm talking about. China is kicking butt. Look at those numbers. 17.9 for the S&P versus 29.6 for the TSX and 36 for Hang Seng. It's nuts. Even Japan at 31 and a quarter ish. The Nikkei. Crazy stuff. Exactly, because those are the American ADRs. If you were trading those stocks on the Japanese or the Chinese, not Japanese, the Chinese exchange, they would have done so much better. That's the argument, right? That's the problem. We were all looking for JD, PDD, all those guys to do really well, and they didn't because we were using the US ADRs. But if you were trading those stocks in the country of their origin, you would have done so much better. Not that I know of. The focus for me is EWY, trading the South Korea ETF because it's the one that gives us the most exposure to the US um, companies, right? Like Nvidia and the ones that are in this SK Hynix, Samsung Electronics. Those are the dominant markets in the EWY. So, if you want to do it the US way, you would use this. If you want to do it the China way, I don't know what to use yet. I guess it would start with the supply chain for who's supplying DRAM to JD, Baba, and Baidu, because that's how we answered the question for who's supplying DRAM to NVIDIA. SK Hynix, Samsung, and KB Financial. Well, yeah, Samsung and SK Hynix. It's something to keep on your radar, anyways. That's pretty much the dominant theme that I have for this year is this capital rotation. Um, I grabbed some snapshots. Let me bring these up because we got to adapt, right? There's different waves to new things. Like when the internet first came around, we had to transition from different stages. So what we're looking at here is the RBC Capital Markets top AI and internet picks for 2026. This is AI 2.0, right? We're past the first term. We're going to be moving from AI infrastructure projects to application and monetization projects. So we need to start getting into data and user relationships. Now they got them broken down on this image into, consumer and internet, infrastructure and supply chains, the large cap must have versions, and then, your core software, the agent hubs and that sort of stuff. I'll share these in the chat. So, you can grab a screenshot or you can just copy it when I put it in the chat. Obviously, I didn't make this. It's from RBC Capital, but I grabbed it when I saw it. Then there's this one. I guess we could just use the buttons. Nope, not that direction. This is the Evercore ISI Best Ideas for 2026. They're running a AI revolution theme as if it was still in the early stages, but they're focused on the K-shaped recovery and value plays, media and technology, power automation, industrials. Doesn't really fit what we're working on, other than they're still focused on AI as well, but they're thinking it's still in the early stages. Got Bank of America here with their top ideas for 2026. They're looking at a thematic shift from capital spending to monetization and returns. Well, that jump back to is the same as moving from infrastructure to application and monetization, right? It's that same thing. So moving from the build out to integration and defense and then revenue generation. These companies have to account for all that money they've been spending, and they better do a good job of accounting for it or they're just going to get their butt handed to them. Then we got Morgan Stanley's themes for next year. And if you look down at the bottom of their outlook, it's that same transition, right? Only they're talking about how the US equities is outperforming Europe and emerging markets, and they still like large cap, strong names with strong balance sheets and cash flow. That doesn't fit. You know what I mean? Like, that doesn't fit because they've been blowing money like crazy. What happened to the Bank of Apple? Well, they spent all their money. That's what happened. But they're talking about, stay away from bonds and high consumer exposure. And they've broke down into software sectors and of course the AI infrastructure, cyclical recovery, and the healthcare revival. All right. So big themes, big themes for next year. I'm gonna share these in the chat, give you guys something to think about. I have not. Yeah, that'd be awesome. Now, I want to highlight that I'm not suggesting we all just run out and buy the names that are on here, right? That's never been my approach, and it just doesn't suit me. Um, but when I'm looking for what new theme I want to play, or how to approach thematics, then I want to be aware of what themes are out there, what names are in that space, where's the overlap, and then I start my due diligence. I'm really particular about liquidity, so I would go through these names, find the ones that I like that have the liquidity, and if they don't, try to find, ETF. Thank you for that. Grab that right now. Then I'll try to find ETFs that have maybe a high holding of that, and I weed them out. I'm not a big fan of just taking everything on the list. Give me a second, guys. I can't type and talk. It's a bad failing of mine that I can't do both, but that is the way that it is. Just about there. I type pretty fast for someone with only 7.5 fingers. All right, all good. So those are a good list of names to kind of think about. Now, I I've got my eye on Meta right now is a big one for me. I've got some issues with it, so I'm not, thinking I'm just going to run out and buy it at the moment. But they spent an unprecedented amount of money to hire the best and brightest names in that space, right? And I mean, seriously, they spent ungodly sums of money. My fear is they're going to get whacked for that when it comes to earnings because it's only been a short period of time and they may not have anything to show for the spending that they've done. But give it a couple quarters and I think that they're going to begin to monetize all of that brain power, whether it's going to be new apps or new AI agents or goodness knows, right? Who I have no idea, but you can't put that much brain power think tank together and not be able to monetize it in some way. And they got access to so many people, right? Between Snapchat and what's all the ancillary companies connected to Meta, it Pinterest, Snapchat, Meta, put them all together, I think it's going to be an ad revenue monster at the bare minimum. And then whatever AI things that they can monetize on top of that, new applications, new programs, new tools, functionality. I see Meta doing really good in the later part of the year. Because in the first quarter, maybe even in the first two quarters, I don't know that they're going to be able to justify all that spending and they're going to get punished by investors. At least that's my concern. If I could find a really cheap lotto to get into, I would probably take it. But I mean, cheap and meta don't really go hand in hand. It's like Netflix. Never anything good when you try to trade Netflix. But I really like these guys. And then there's Apple. You know, um, Apple is like the butt of all jokes when it comes to having some form of AI. It's starting to really tarnish their image. And it makes you wonder at what point they're going to resolve that. And of course, how are they going to resolve it? I've learned not to bet against Apple in the big picture. But I mean, you can see they're breaking that key level right now. They're headed to the downside, 250 easy. If not, 240, maybe 245. It's got some downside coming. The problem is this. Look at that beautiful wave. And it's been running that way since '07. Probably if I put more time on the chart, it would be running that way even further. My Linreg line isn't going to snap because we're in log scale, but still, this is just the swing low, right? We swung high. We're going to have to come down and swing low, and then we'll turn around and do it all over again. For a monthly chart, I have found that it will help normalize things, right? Let's do it this way. We'll put Apple over here, and we'll also put it on monthly, but I'll turn off the log scale. Man, I was just there. Come on, get back in here. We'll turn all this noise off. Now, some people leave the log scale on all the time. I'm not one of those people because it messes with your drawings. But on a monthly chart, it can really help you see what's going on. So this is Apple with no log scale on a monthly. And this is Apple on a log scale monthly. They're both going to 2007. The one on the left is so much easier to read, but I only do it on this one chart, right? Um, be careful if you get to messing around and changing your charts like this, that you don't accidentally change a daily or a weekly chart and then you don't know that it's changed because it can screw up what you think is there, like a cup and handle or a head and shoulders or something like that, when it really isn't there at all. It's only there because you have the log on, and then you find out later that you were completely uninformed because it wasn't real. So for me, all my other charts are saved so that if I hit the button and I go to another one, it turns off log. Log is only there on my monthly. I kind of built in a default process to make sure it can never get a log scale chart any other way. So I do see some pain for Apple, but I wouldn't count them out. I just keep looking at the clock, wondering when they're going to come in with a solution. And make no mistake about it, they're working on a solution, right? Everybody knows Siri's a turd. It's a completely worthless tool, completely worthless. And they're going to need to do something at some point, but I don't know how drastic they're going to get. Lots of speculation that they're going to collaborate with Google and Gemini, but that's just rumor and speculation. You know what I mean? There's no proof of that, and it's really kind of hard to believe that they would. But at the end of the day, money's money. All right, on the growth versus value front, is like the big capital rotation. We're still bleeding down. So we don't have, a dominance in the growth value space. And the Mag 7 is underperforming the broader market. That's not really a bit of a surprise because it was such a crowded trade that, people are getting into the old tech, junior tech, and just the less crowded tech, right? But it won't last. But for right now, you don't want to try to run the Mag 7s because they're underperforming. And if we look at this is like a flight to safety signal. If we was going down, that would be the markets in fear, running defense, hedging their plays, looking for staples, and it's not doing that, right? It's going up. So there's no flight to safety. People aren't scared. They're not running for the hills. Margins are low. This is the Mag 7, just comparing it against the broader market. If it was going up, it would say the Mag 7 is outperforming the broader market's best, and it's not going up. It's kind of sideways after falling down. So again, the Mag 7 isn't outperforming the best names in the broader market. Now this, on the other hand, let's keep that spread out for a moment. That blue line on the bottom is the combo, the ratio that we're seeing here, US Japan combo. It is a great proxy for what our markets are doing. Yeah, we turned over this afternoon and we started to fall back down, but we broke out of the high of the range and we expanded nicely. Now the US markets didn't get that expansion yet, but this leads. It doesn't follow. So if it broke out like here on the daily, you can see that. I'm going to move this chart now. We're going to lose that really good picture, but keep it in mind. Once I scoot this over, they're all broken now. But look at this. That's the breakout that I'm talking about. We got through that 4.95 level and the S&P didn't, the Nasdaq didn't, but this already did. If this is a Busby and it bounces on 4.95 and goes up again, S&P and Nasdaq's going with it. The problem is I don't guess if it's going to bounce or not, right? We got to see if it's going to bounce. So, you know, that's what we're waiting for. That's a perfect setup. It's bullish. That shows our markets are healthy. We already know that, or we would be crashing and burning. The Mag 7 carried us for like 18 months. Those 7 names did all the heavy lifting. If we were going to crash and burn without their help, we would already be doing it. We're not crashing and burning. We're just not running, right? So there's a big difference between those two. Once they do start to run again, that might be the bounce here, right? And then we get that turn and start heading back up. Oh, yeah, yeah, yeah. I mean, we can we can certainly cover that Friday. Um, for those who don't know, the Discord has bots built into it, and depending on what I'm doing on my screen, oftentimes I will just use the bot to bring up what I want to see rather than moving my chart to do it, especially if I'm in a trade. I don't want to leave the chart screen that I'm on, so I bring up the chart in the Discord. But yeah, we'll get into that Friday. If you notice, they had a bit of a theme to them. All right, guys. I think we're gonna wrap it up there. I think it's a good place to start. Everybody, be careful. Have a good night. If you got topics you want to cover or areas of interest, just chart analysis, trade ideas, whatever, guys, it's open mic. Always feel free to come up with some ideas for the streams. I love it. And of course, everybody benefits, right? Because then we record it and we share it out to others. I have found most of the time that if somebody has a question, so did somebody else. They just didn't ask it yet. So when you guys ask questions, you get to answer somebody's question out there. So I like that. That is awesome. The more you use it too, the more it will become a part of what you do on a day-to-day basis. That's exactly right. Distance from VWAP, reciprocation. And the cool thing is, if it starts to fall apart, you've already got that as a warning because you know where it's supposed to go. So if it isn't going there, you're like, yeah, no, 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 this is broke. It's not doing what it's supposed to do. You can get the heck out or, run it the other way because hey, it's misbehaving. It's not doing what it's supposed to. Of course, glad to do that. Can't see the um it's a bit late for this person, but we'll do it anyways, and then we'll wrap it up. I don't know why she can't see it. I can see that she's in the chat with us. You like that style, huh? There's days where it works out so well, it's almost a shame not to do it. You know, you're like, oh, what a gift. I'll take that. You just want to be careful on those days where we've gone sideways and it's really tight and we're not doing anything. On those, they can get really sneaky in the afternoon and then suddenly explode on you. Yeah, those hurt. So it's good on days like this where we've already been running a long way and you know the market's tired and it's stuck now in the position that it's moving and it's just like, "Oh, thank you. I'll take that. That's nice." Works out really well. That's my approach is to have an idea what price is supposed to do. That way when it if it starts to misbehave, I've got that heads up. I don't have to wait for my stop to get hit. I'm not looking at indicators to give me clues. I'm just looking at price and thinking, you're not doing what you're supposed to do. And I can get out or reduce my position, try to defend it somehow because I've already got in my mind what price is supposed to be doing. And if it's not doing that, then I know something's wrong. That's a ex- Yeah, simple works. Simple is the best approach. The simpler you can get it, the better. That is my overriding theme for a lot of what I do. If I can't visualize the trade, I'd really rather not take the trade at all because I can't see it. If I can't see it, I don't understand what it's supposed to do. And that sounds maybe a bit odd for anybody new who maybe hasn't had a trade that they know what it's supposed to look like. But once you start taking trades that are familiar, you know what it's supposed to look like. And if it starts to misbehave, well, you know that too, because it doesn't look the way it's supposed to. Um, the method, I don't really know if there is a method to it. I would call it measured move, I guess. Um, Linreg boundaries. I don't particularly have a name for the method. It's price action analysis, measured move, and reciprocation is the word that I use. Most textbooks do go into it, they just don't use that word. Um, the replay is on the YouTube, and of course, I will be putting it in the chat. On Friday at 2, we'll be back to do it again. So, Sophie, if you have questions on the content after you watch those, you can hit me up with trade ideas or topic ideas or show up Friday, ask questions. Love to have you, and we'll answer them then. Yep, yep. All right, guys, I will see you tomorrow morning for the morning briefing. And the reason I started late today is I was trying to get